Every trader on social media right now is talking about standard deviation, and quite literally what they're doing is they're taking Fibonacci extensions on swing legs and then labeling them -2, -2.5, -4, and then calling it standard deviation. But there's just one problem. That is completely not what standard deviation is. Not at all, not even close, guys. I'm going to show you what they're actually doing and why it's just rebranded Fibonacci, and then what I'm going to do is I'm going to teach you what real standard deviation is and how you can quite literally use it to predict exactly where you can actually top and bottom tick the market. So buckle your seatbelts and let's get into it, guys. Also, I just want to say thank you so much for the support so far. I'm trying my best to bring you guys, banger content like this. And yeah, let me know what else you want to see. So, I want to reiterate, right? If you've been on trading TikTok or YouTube, in the last year, you've been seeing everybody talk about standard deviation, right? Drawing them on the charts, using them for entries, calling out like the -2.5 level, the -4 level, for reversals. And we're going to go over it on TradingView. I'm just kind of, this is going to be a long video, guys. So, make sure to make sure to fucking grab your popcorn, sit down, get your blanket and get ready. But, I just want to preface, like, I'm not here to hate on anybody, right? But I do need to tell you that, like, you need to realize, guys, that the way you think about this needs to change, because what these gurus and these influencers are showing you is not real standard deviation, right? It's just a Fibonacci extension with a different name or a completely different concept of just like, for example, like Powell here, right? You guys know, like, again, this is not me hating, right? We got the X on that, right? He was the kind of pioneer of top and bottom ticking and showing you where the market, can have a crazy reversal from. But in reality, that's just complete discretionary trading based off technical price action. There's no stats, there's no understanding of variance, real standard deviation of what he preaches. So, he's not really teaching you the right concepts. And it's crazy because you need to know what the reality is. And I'm here to expose the reality for you guys. I'm going to prove this, right? Not with opinions, but with actual math. As you can see, we're going to be talking about bell curves, right? We're going to be talking about normal distributions, and it's very important to understand how these dynamics and these concepts work all, in tandem with each other. Then what I'm going to do is I'm going to show you how you can actually use it. Okay, not, the theory behind it. Obviously, I'm going to, talk about the theory, but I'm going to show you how you can actually use it to call tops and bottoms on NQ with real statistical probability, behind it, right? Not just, oh, like this level might work, right? But like a highly probable confluence and, high probability trade that you can use. So you can see right here, right? Basically, a lot of these videos are like, oh, this is a rejection block, right? This is like some level of some top, some wake of some price action pattern, and then essentially you put a limit order at some point, and then you end up bottom or top taking the market, right? And a lot of other people, they will, again, like I said, this is the whole point. They're taking extensions of price data and then, Fibonacci extensions, and then calling these levels top and bottom tick levels. And we know this is just not the truth, right? Because how you draw these are completely arbitrary. And I made a little flow chart here on basically what they're teaching. So we're going to kind of go step by step, exactly what people are doing when they say standard deviation on TikTok, on, YouTube, whatever. And yeah, we're going to break this down, right? So step one, what they usually do is they identify a manipulation leg. So what they're doing is that they're basically marking out a swing high and swing low. And don't worry, guys, I'm just trying to verbally, say this to you, and then we're going to go on the chart and I'm going to show you an example. But they're basically identifying a manipulation leg, right? Usually what ICT would call, a manipulation leg or whatever, right? Smart money concepts. Then what they're doing is they're opening the Fibonacci tool. All right. So you guys know on TradingView, there's the Fib tool. And then in the Fib tool, they're basically using custom settings of like 1, 0, -1, -2, -2.5, and -4, right? Then what they do is, for step 4, is they anchor that Fib to the swing leg, and then they call these projected levels standard deviation. And we know this is just not true. This is not how it works. So over here on price data, I've shown you kind of an example of how it works, right? So for example, they'll just take like a random swing leg like this, and then they'll have all these extensions marked out, 1, -1, 2, 2.54, and then they'll just like have these marked out on their charts, and they extend the line out, and well, you can see that, for example, people say, oh, the -4 is super good, it's a great crazy bottom tick area, right? They'll then just put a limit order right at a point right here, like a 1-2 tick stop loss, and then they go for like a 20R or whatever, and they say, oh my god, I bought them, take the market. But we know if you actually look at this, this is completely random, right? Anybody can mark out any type of leg. I can mark out this leg, I can mark out, you know, this random leg like this, and this is kind of like what they're doing. So another example we have over here is, you can see, right, we sweep that low, right? People will call this like a sweep of a low. This is the manipulation leg, right? That comes down, and they'll take a fib tool from the manipulation leg and then draw these extensions either from here to here or from here to here, and then just draw out those extensions, right? So in this case, you can see, excuse me, oh my god, if we use this this leg right here, well, you can see that it basically top ticks the, like, this area right here. This is minus 2.5, and basically the whole point is like, basically is how you draw this is completely arbitrary, completely random, so it has no meaning, right? Because like, what's actually going on? Okay, here's basically what's happening mathematically. The Fibonacci tool is taking the height, okay, of your swing leg, like relative to anything, just taking the height of this region. So for example, like if I mark out like here to here, like let's say we're using this area to this area, right? It basically marks out this region like this, right? Just like this. That's what the Fibonacci tool is doing. And then all it's doing is it is literally linearly multiplying it. That's it. So if your swing leg is like 50 points, the -2 level is just 50 times 100, which is 100 points projected out, right? Extended out. And then the -2.5 is going to be 50 times 2.5, which is 125, and then so on and so forth. And then as you can see, they call these projected levels standard deviation like this. But like I said, this is the whole problem. This, and let's see if I can, do I have a drawing tool? I guess not, but this is the whole problem, right? You can see that this is just a Fibonacci extension with renamed levels. There's no mean being calculated, there's no variance being measured, and there's no distribution being analyzed. This, you know, -2.5 or -4 has literally no statistical meaning. It's literally the swing range times the multiplier, which is the projected level. And what I was giving you or telling you in the example on the chart, this is exactly what it is, right? What everyone on TikTok, Powell, all these people, all these other random kids, they're just teaching you Fibonacci extensions, right? Swing leg, 50 points. The math is behind what I told you. The -1 level is going to be 50 times 1, which is 50 points. The -2, 50 times 200, so on and so forth. This is just a basic multiplication, not standard deviation, no mean, no variance, no data, okay? Now, this is what standard deviation actually is. So standard deviation is a statistical calculation. It is a characteristic of a phenomenon, okay, of a data set. It's used to describe data around a mean. And if you guys have taken a high school stats class, you know, an introductory college class on this introductory college stats class, you should know what this, you know, what these concepts are. The difference is that this metric is calculated from real data, okay? So this is giving you real probabilities. You're getting the mean, the variance, as well as the distribution. Now, the thing is that, like, can the Fibonacci extension method, which is what we should really call it, the fake standard deviation method, can it work sometimes? Absolutely, right? Fibonacci extensions do work, and they've always worked, but projecting swing multiples to give you levels that price, you know, like reacts to is not. It's kind of useless, bro. Now, does like the Fibonacci extension fake standard deviation method work sometimes? Yeah, of course, right? Fibonacci extensions do work, and like we know, like they've always worked, but and projecting swing legs, swing multiples gives you levels that price does react to. It absolutely can do that, right? But I'm not saying it's useless. What I'm saying though is calling it standard deviation is completely wrong. And the reason is because real standard deviation is way more powerful, damn near exponentially more powerful, from every single angle, from every single aspect. And I want to show that to you guys. So this is all great, right? You're like, okay, shit, like I understand what Fibonacci extensions are, like, but I don't know what does this mean? What is variance? What does this all mean? Like, I've never taken a stats class. I don't know what's going on, right? So let me explain to you these basic terminologies and stats, and then we can go from there, right? So what is mean? Simply, okay? So a mean is going to quite literally be the average. You guys maybe, you know, in elementary school, maybe middle school, you guys just did basic addition, right? You probably added numbers up and then divided by how many numbers there are. That's literally what mean is. Okay, you already know this. If NQ moves 100 points on Monday, then, you know, 150 points on Tuesday, 80 on Wednesday, 120 on Thursday, then 50 points on Friday, the average of the whole data set of all these days for that week was what? 100 points, right? All we do is we add up all the moves, right? 100 plus 150, 80, 120, 50. that gives us 500, and then we literally divide by the number of days, 1, 2, 3, 4, 5. The mean then is going to be 100 points. You know, this is a normal day. This is basically the center of gravity, which, you know, if you I like to call it that. And then we can basically measure how far each day deviates from this. You probably notice as well that some days NQ moves way more than average, and then some days it moves way less, right? That spread, how far each day moves, is from the average, right? And this is what standard deviation basically measures. It basically just quantifies a means of expressing how far data is from the average. All it is. So just to preface again, right? All the mean is showing you the average of a data set. Okay, and in this case, obviously, we did the thought experiment of where I show you if we measure, you know, a week's worth of daily movement, or excuse me, yeah, a week's worth of daily movement on NASDAQ, and we find the average. Well, we can see on average, right? NASDAQ moves what? 100 points. Standard deviation, like I said, basically just quantifies how extreme something is, the abnormality or the extremity of a data set. I have another visual here kind of explaining this, right? This question of how abnormal a move is. And this is just a beautiful fucking picture. And yeah, I'm here to explain this to you guys. So let's think about it like this, right? If NQ's average daily move, right, the average range is 100 points and the standard deviation is 30 points, what this means is that on a normal day, NQ will move between 70 to 30 points, right? That is one standard deviation above and below the mean. But a 200-point day, that is more than 3 standard deviations, right, above normal. That almost never happens. Statistically, a move like this happens less than 1% of the time. If we observe the data set, if we observe all the samples of, you know, all the days of where NASDAQ moved 200 points, well, in all of those days, it moved 200 points less than quite literally 1% of the time. And this is why standard deviation is so powerful for us as traders, day traders, traders in general, because we can measure how abnormal excuse me, the current move is in real time, and we can know the probability that it continues. You can see here again, right? I just want to make it very simple for you guys. This isn't a crazy concept, but I want you to think about this intuitively, and that's why we have this visual, right? What this is saying is that based off our data set, based off what we measured in the previous example, right? In one standard deviation, plus or minus, right? Because it can go both ways. In 68% of the days, the average daily range was between 70 and 130 points. Now, logically, right, if we increase this band, right, and we say 2 standard deviations, now, well, naturally, more of the days are going to fall in this range. So what the 2 standard deviation level or the band, the range is saying is that in 95% of the days of the observed samples, NASDAQ move between 40 and 160 points on the day. The farther and farther and farther you move away from the mean, the less probability that it's going to happen. As I said in this example, right? A 200-point day, which is 3.3 standard deviations way past the 190 points, almost never happens. It only happens less than 0.5% of days. So in essence, standard deviation answers this question: how abnormal is this move compared to what normally happens? I have another graphic here kind of describing this phenomenon and showing you what a normal distribution is. It's called the bell curve. So there's a concept in stats called the 68, 95, 99.7 rule. And all this is saying is that it basically kind of generalizes these the data in relation to standard deviation. All it says is very simply is that 68% of the data lies between 1 standard deviation, 95% lies between 2 standard deviations, and 99.7 lies between 3. Again, all this is measuring and saying is that in 68% of the observed days in our data set, in the sample size of days we recorded on NASDAQ, the range, it lied between plus or minus 1 standard deviation, which numerically is between 70 and 130 points. I'm just going to say a very contrived example here, but let's say we have, 1,000 trading days that we have in our data set. What this means is that in 680 of the trading days, the daily range was between 70 and 130 points. So essentially, like bringing it back to TradingView and NASDAQ, right? When someone says basically that price is at minus 2.5 standard deviations, what they should mean is that price has moved 2.5 standard deviations away from the average. And we know, based off what I just told you, that statistically speaking, only 0.6%, 0.5% of moves go beyond this point. What I just said is an actual probability statement. What they're saying though is that price has traveled 2.5 times the length of a swing leg, which is just a fib extension and tells you nothing about probability. All right, so again, basically from what I just said before, just to drive this point, harder, looking at an NQ, a daily range distribution of, where's today's move, right? We can see that, based off, again, what I just said, I'm so redundant today, a 2.5 standard deviation move only happens in 0.6% of the days observed, right? So again, only 0.6% of days, go further than this, right? And as you can see, like, once I urge you guys, go and do this. Go and record the, for every single day on the NASDAQ, go and record the range of the day on NASDAQ and go collect this data on your own. I really urge you guys, and do your own statistical analysis on this because it's going to be really eye-opening. Open up an Excel sheet, all right? Go to TradingView, take your range tool out. You guys should know how to do this. And quite literally just measure each single day, record in an Excel sheet, and then boom, you can literally calculate the mean, variance, standard deviation. And if you fit a normal distribution on it, it would look something like this. Now I'm going to get into this a little bit later. It's called kurtosis, but for the most part, this is basically what it is. I want to continue the video by really showing you guys an analogy on standard deviation. We're going to make this super simple with an analogy, right? We're going to use height as an example because you guys should, you guys know about height. Maybe looks max, and y'all are some looks maxers in here. You guys know about height. You're watching Black Pill content. But yeah, the average American, man is 5'9", okay? The standard deviation of male height is about 3 inches. All right, so what this means is that 68% of men are between 5'6" and 6 foot. That is plus or minus 1 standard deviation. 95% of guys are between 5'3" and 6'3", which is plus or minus 2 standard deviations. And 99.7% are between 5 foot and 6 foot, which is 3 standard deviations. And well, this should obviously make sense, right? If you meet a guy who's like 6'8" or 6'9", that is more than 3 standard deviations of the average, above the average. That is so statistically rare, and you're almost never going to see it. Now, I want you to think about this same principle on the NASDAQ. If NQ's average move in the AM session is 80 points, and it's already moved, let's say, like 200 points, right, by like 10:30, that's like meeting a 7-foot tall person, 6'8", 6'9", 7-foot tall person, 6'7". It can happen, but statistically, that move is almost certainly done expanding. This is what real mathematical standard deviation shows you, right? Not just, oh, here's a level, and let's just draw extension from just a random swing leg, a random level. It tells you here's the probability that this move keeps going. All right, so I kind of hope that you've kind of gotten an idea and you've solidified your understanding of statistics and mean and standard deviation, kind of like of what I've showed you with all these examples. And yeah, to really sum it up, I mean, you can see the difference, guys, right? Real standard deviation is calculated from the mean, right? It's calculated, or not, well, it is calculated from the mean, but it's calculated from data, right? You need a sample 20 days, 50 days, 100 days of price data, and then you calculate the mean and then the spread from that real data. What retail traders, again, are calling standard deviation is just taking one swing leg and then multiplying it by a number. There is absolutely zero sample. There's no mean. There's no data. As basically like me saying, based off the height analogy that I just showed you guys, right over here, right? Like I met one guy who's 5'9", so I'm going to multiply his height by 2.5 and call that the standard deviation of human height. That makes absolutely zero sense, right, bro? Like you can't just look at one example and then just multiply it by a random number and then call that standard deviation. You first need to measure a shit ton, pardon my language, of people first, like a bunch of people first. And that's the same exact thing in trading, right? You just can't take one move and then derive a standard deviation from it. You need a distribution of moves. So what I'm going to do next is I'm going to show you how to actually use this on the NASDAQ, okay? And this is genuinely one of the most powerful tools for applying real standard deviation to, intraday trading and just trading in general. It's called the VWAP, okay? Volume weighted average price. All right. And it's with the standard deviation bands. VWAP, again, volume weighted average price, is basically the true mean price for the day. It's not just a simple average, it's weighted by volume, which means it represents where the most transactions happened. All right, institutions actually do use VWAP. Banks, other funds, quant funds, macro-based funds, they actually do use VWAP, which is kind of crazy. Even trading desks use VWAP. It's basically the center of gravity of price. When you add standard deviation to VWAP, right, you have your plus and minus 1 band, your plus and minus 2 band, as well as your plus and minus 3 band. But what these do is, again, they just show you the deviations from the mean, right? The 1 band is going to show you 1 deviation from the mean, 2 bands are going to show you 2 deviations from the mean, and then 3 is going to show you, well, 3. And now you actually have something that fib levels can never give you: real probability. So you can see here, right, what happens basically is that in a period, right? A period is just a range of time. What VWAP is doing is that it is just taking the mean price in a range of time. So in this case, you can see we have 0 and then 250 intraday bars. The VWAP is just giving us the mean price of this range, of this price data. When price touches the, plus or minus 2 standard deviation band from the VWAP, you know that statistically 95% of price action of the price data should stay inside this level, which means that price is at the extreme. It's at a probabilistic extreme. So what this means is the probability of reversal is high. And now notice we have these bounds, right? We have our 3, 2, 1, but in reality, VWAP and standard deviation is a range, right? It's a band of ranges. Now, while you can use these actual boundary points, we'll get into that in a different video most likely. I really just want you to focus on the region, right? This is a region, an area. You can see in this example, price just touches the the plus 2 standard deviation, and then there is a 95% chance that it stays below this level. It's basically a high probability reversal level and a basically top tick entry level, like a real top tick. Comes into that area, price moves down. Same example right here, right? It comes into that, it touches the first part of that minus 2 band and then ends up reversing. If we use our example of 3 standard deviations, right, 99.7% of the price action of the price data should stay inside, and that's how you top tick. This is how you do it, right? You're not looking at a fib just because you draw a fib and you're attaching it to some magic number, right? You're multiplying it by some magic number. You have a statistical framework that is telling you the probability of this move occurring is less than 1% or more than 1%, right? All right, so let's get back into TradingView. I'm going to show you exactly how you can mark this out on TradingView and how you can use VWAP on TradingView on NASDAQ and kind of illustrate the point that I'm trying to make. So all you do is you come to NASDAQ, right? And then you come down to this 4th bar over here. And you can see it's our forecasting tool. And then you can see right here, we have our volume base. Basically, we have our anchored VWAP and we have our, our fixed range volume profile. Now, I don't recommend actually using TradingView for volume. I recommend you use like a different platform like ATAS, maybe NinjaTrader. There's a lot of custom scripts for VWAP on these actual order flow platforms. There's MotiveWave. There's a bunch of order flow platforms, because on TradingView you have very limited access to these indicators. Now, this is the built-in one. Maybe there's something on the indicators tab, but for example, you can see when I anchor the VWAP, or like I put the VWAP at a certain point, I can't cut it off. So for example, like when we're not really in this dealing range anymore, like this VWAP point, this level might not even matter, honestly, because again, choosing your period is kind of subjective. So in this case, what I do want to do is let's say we anchor our VWAP, at the start of a session. This is called a session VWAP, a session volume based oh my god, I was gonna say the whole name, but a session VWAP. And based off what I just told you, again, I'm just trying to make you have an intuitive understanding of how VWAP works. You can see when we anchor it to this recent price data, and then we let some price data play out. Let's just say we're doing like an Asian session VWAP, right? That we cut it off, over here maybe. This right here is our main band. This is our main VWAP band of price. Okay, this level is going to be our -1, this is going to be our -2, and this is going to be our -3. For this purpose, let's just say we're not using -1, we're only going to be looking at -2 in this case. And actually, we should put -1 because it gives us the range. Now, we're not looking at these boundary areas, but you can see right here that we have these overall regions, right? If I were to mark out these regions, right, you can see these areas have their own regions. And this is exactly why VWAP is so powerful. Now, I urge you to use multiple confluences when doing this, but the whole point that I'm trying to illustrate here is when price gets to these extremes, we should snap back to the mean or revert to some other extremity based off other price action. So in this case, you can see in real time, right, you would be basically waiting for price to, hit one of these bands. And the reason is because when you're just using a when you're anchoring VWAP to a starting level, there's not enough data, not enough intraday bars, right? So that's why you want to have some decent data behind a period, especially on the session VWAP, to make an informed decision. But let's say you were just using it just straight off the session, right? When the mean's over here, just off this session, well, when price gets into this area, right, you know that it should snap back. And well, look what happens. We get into this -2 region. This is our -1 region right here, right? If I were to highlight this is -1, and then this area is -2, right? And then look what happens. We trade into that -2, and then we end up having a crazy reversal, right? So I'm gonna mark out where you would have probably got in. Let's say you're entering off a candle confirmation. Let's say you enter in off here, stop loss, below the low like this. Look at that. You could have gotten up to a 3R trade. Let's say you were scalping. Look at that, 1-to-1. Same principle. Like, let's say you're taking trades into this whole range. You're waiting for the level to be hit, and then you're waiting for that confluence to be there, right? Well, you would be getting in essentially either here, or here, and look what happens, right? Let's say you took this trade right here, right? Super tight stop. You're targeting, like a 1 to, let's say you're going for like a 1-to-5, right? On average, like this. You would have probably got stopped out here. You see another confirmation right here. Then another one is going to be right here. You get in and look at that. Boom. 1-to-5. Same thing. Price trades into that -2. You wait for that candle confirmation. Get in here. Stop loss below the low. And then look what that ends up being. That ends up being the bottom tick of the whole move. And then you take it to like Asian high. That's like an 8R. The whole point, again, is to illustrate that when we hit these areas, we should have some type of reversal based off this idea of statistics and standard deviation of the probability that this move rarely occurs, so it should revert back to its mean. Now, something really cool, like I just said, is let's say you're combining this with supply and demand or ICT concepts. You can align these levels with your areas of supply and demand and ICT concepts, right? Let's say if we just simply zoom out here, right? Price is trading in this range on NQ. Okay, we have a supply demand. We have a supply level here, or just gonna be demand level here. We have another level right here, and let's just say we have another level right here. We also have, right, this huge imbalance, this huge imbalance in price like this. So realistically, we have this huge imbalance and these two levels, and then guess what? What's our one level that is aligned up with our VWAP? Because in real time, it would have been around here, right? Price keeps moving down, our VWAP band starts to be around here. Well, most likely, or just with just basic logic, you would have taken this trade. And then same thing, let's say price comes up here, and then in real time, remember, our VWAP band is going to be like this, right? If I mark it out in real time, you can see our VWAP band, our -2, is in this area, right? So then what happens? We can just, again, put another limit order, maybe at the level somewhere in this region, right? Stop loss covering the low again, right? And then targeting the mean, let's say the main VWAP band, not in that 1-to-8 RR, that 1-to-8 R example we use, but just something like this, even, assuming you didn't want to go for that 1-to-8, boom, look at that shit, boom, 2.5 R. Targeting this high, that's a 3R. Remember, guys, there's always three periods, 3 anchor points you want to use: your session, your weekly, or your monthly. I urge you guys to test other data sets and other intraday bar periods, right? But there's just a plethora of ways to use VWAP. You can use a 2-day VWAP, a 3-day VWAP. There's multiple ways to do it. All right, so now that you've understood that, all right, this is where it gets even more practical, because I love you guys. I'm giving you guys even more sauce on how you can use this. All right, so instead of looking at VWAP based off the whole day, right, like a session VWAP, you can calculate standard deviations for specific sessions. Because again, what is the whole overarching theme of this video, and the point of this video is that standard deviation is a characteristic of a data set. So you can collect data in any means, in any form, and then calculate these metrics based off the data. For example, let's take the Asian range on NQ, right? We know that Asian session, obviously, who cares about Sydney and Japan and China, right? Let's just condense it all into one. Asian occurs from 6 p.m. EST to 3 a.m. EST. If you measure the Asian session range over the last 20 to 30 days, which I have in this example for you guys, you're basically going to get a mean range and a standard deviation. Let's say the average Asian range is 35 points with a standard deviation of 12. What this means is on a normal day, the Asian range is between 23 and 47 points. Very simple. If Asia gives you a 15-point range tonight, that is unusually tight, which is just compression, right? The expansion that follows has a very high probability of being larger than normal. If Asia gives you a 70-point range, that move is already blown past 2 standard deviations. So the move might already be exhausted before London even opens. This is so important if you're an ICT trader, right? If you have this compression, you can then expect a large expansion in London or New York. If you have a normal Asian session, right, a normal range, 22 to 43 points, a standard day, it's going to be normal expectations. There's no special bias you might have. And then when you have a wide Asian range, your move might be exhausted before London even opens. So you're not really going to have a crazy move in London. I want to kind of show you like a visual example of what I mean, right? You can see right here, we have a kind of a tight Asian session and we have a very big expansion. Now, if I show you an example of where we have a very big Asian expansion, right? Like here, very big Asian expansion, then guess what? Our resulting, London and New York isn't actually crazy, right? Relative to the actual day, like we're not continuing to extend the move. We obviously, we reverse and retrace to reclaim that, but I'm just going to give you an example, like an intuitive understanding of this. You can see right here as well, you can also do this with the expected daily range, right? If NQ's average daily range over the last 20 days is 150 points with a standard deviation of 40, well, a normal day is going to be what? Between 110 and 109 points, and then the big day is going to be 2 standard deviations, 230 points plus, and then a very crazy day, a monster trending day, is going to be 270 points plus. That almost never happens. I want you to start asking yourselves questions that really kind of tie in this whole concept together, right? Like, for example, I'm going to give you another thought experiment, right? If it's like 1 o'clock, let's say it's like 1 o'clock in the afternoon, and then NQ has already moved, 220 points. You know that statistically that this move is extended. Okay, so the probability of it pushing to 270 points is very unlikely. So if you are looking for a reversal entry, this is exactly where you want to look for it. Not because a fib extension line told you to, oh my god, I can't even fucking speak, told you to, but because the math tells you probabilistically that this move is overextended, because it's at this time, as well as it's already at this extreme level of deviation. All right, so far I'm hoping this is making sense to you guys. Drop a comment down below with feedback on how you've been liking this video. I'd really appreciate if you guys like and sub as well. It takes me a long time to make these videos, and just so I know you've been watching, and for my OGs and people who actually have been trying to consume this content and make it make sense to them, type the word square roots. Okay, so I know that you watched the video, and if you do, I'll drop something special in my Discord for the people who commented square root. But to continue, right, you're probably like, AA bands, like, oh my god, this is so cool, right? Like, if we know that we can mathematically calculate these statistical probabilities and improbabilities, well, why don't we just every single time, just look for a 2 standard deviation or like a 3 standard deviation move, and then just trade back the reversion to the mean, right? Why can't we just do that every single time and just have like 100% win rate and make money, forever, right? And the reason for this is because I have to be honest with you about this whole thing, about standard deviation distributions, especially in the world of finance and trading, right? I don't want you to think that this is a cheat code, because it's not. It's definitely, obviously, necessary to understand, and have an edge and, really statistically reason to be intelligent about the markets. But the normal distribution, right, that I talked to you guys about over here, let's go back all the way and show you guys, right, the normal distribution, this whole example, this idea of, fitting data around a mean, all right, it's not fully accurate, all right? The bell curve, in reality, this just assumes that price movements are random and symmetrical, but we know that, again, in reality, the markets have fat tails, and this idea of fat tails is essentially the ends of the distribution. And I want to illustrate this over here with this example over here, right? Markets have fat tails. I'm showing you side by side what a perfect bell curve is, a perfect normal distribution, right beside a real market, right? A market that has real returns with fat tails. Okay, what this means is that extreme moves, even though we would think that these moves, these 3 standard deviation moves, days that where they happen are just statistical improbabilities, they happen way more often than the bell curve can actually predict. A 3 standard deviation move should happen 0.3% of the time, let's say, right? But in reality, on NQ, it might happen like 1 to 2% of the time, which is crazy to understand and fathom, right? But does this make your standard deviation useless? No, it doesn't. It just makes you have to adjust your expectations, right? Instead of targeting like a 2 standard deviation move, right, or treating it as like like, oh, 95% of the time it's like it has to happen, or like a certainty, treat it as a high probability reversal zone. Use it with other confluences. Maybe you might have an extreme level of supply or demand. Maybe you might have another order flow confluence. Maybe you're using some ICT concept, right? Use it as a framework, not a guarantee. Because again, real financial markets are almost just never static. They're always, evolving, and there's new data being presented, and this idea of kurtosis and having fat tails. And for you guys who've taken calculus, or taken like a calculus class, you can see there's more area under this region, right? So obviously there's going to be more instances, and numerically more iterations or instances of this idea of more instances of a certain standard deviation, or and statistical idea occurring, right? Because there's more area under the curve. Even with fat tails, this is still like 1,000x more mathematically sound than just multiplying a swing leg by 2.514 and then calling it a standard deviation. At least real standard deviation of what I've taught you in this whole freaking video up until now, like, damn, this is like a 40-minute video, damn near an hour long video, is calculated from actual data and gives you like a real approximate probability, right? And the fib method just gives you nothing but a line. Literally, that's all it is. It's just an arbitrary line. All right, so because I, love you guys, I'm going to quite literally give you the simplest framework on how you can actually top and bottom tick with real math that you can quite literally start using tomorrow. Okay, so let's just do it step by step. So number one, I already showed you how to add a VWAP as well as your standard deviation bands to the NQ chart. There are, again, better indicators. You would have to do your own research. Again, that's kind of out of the scope of this video. I'm just kind of here to show you the theory and the concept itself, not really kind of, direct you towards resources and, all of that. But the VWAP's going to be there, and then, you can add your standard deviation bands to the NQ chart, right? Add your 1, 2, and 3 bands. Again, most platforms have this built in, and you, again, want to use an order flow platform optimally, okay? And then number 2, step 2, know your numbers, right? Calculate the average daily range as well as the standard deviation of that range over the last, let's say, 20 or 30 sessions, 20 or 30 Asian sessions, or, daily days, right? Whatever you want to do. You can do this in a spreadsheet very easily. There are actually indicators, and, I will say that my students and I have this indicator because I hired a dev to make this indicator for my students and I that I use every single day. Maybe we can kind of cover it in another video, but it's for the mentorship students only. So if you want to, get that indicator, apply for the mentorship, going to be linked in the bio. But yeah. Essentially, you can do this in a spreadsheet, just mark down everything manually. I would do it back in the day by myself, by hand. Very easy to do, okay? During that session for step 3, right, you want to identify the zone, right? Where price pushes to, the plus or minus 2 standard deviation level from VWAP, and then the total daily range, okay? And essentially, we're adding 2 confluences, right? When the VWAP is at the 2 standard deviation, as well as the daily range is at the 2 standard deviation, well, that's your zone. That's your high probability reversal zone, right? In that band, in that area. And then that's when you look for signs of reversal. And then step 4 is the execution. You saw in the examples that I gave you earlier on, I showed you earlier on, right? If you put a limit order with a very tight stop, well, you're going to get stopped out a lot of the times. So what you want to do is I can't tell you your execution method. Do you want to put a limit order at the level in the middle of the region? Do you want to put a limit order based off a relative supply or demand level that's lined up with the region? I can tell you from experience, you want to enter in off usually a doji candle confirmation. Again, I cover that in the mentorship, but it's usually a strong candle confirmation. But in addition to that, there's a bunch of other execution methodologies. You can look for a market structure shift, change a character, break a structure, quote unquote, displacement, and then a fair value gap at the at the standard deviation extreme level. So if it hits that level, then you see a change in character, then you just expect the retrace into the fair value gap, and then hopefully it can go even higher, right, to your level. And then that's all it is. It's just you execute, right? So now I've literally given you a amazing strategy and framework, right? Wait for your VWAP to hit the 2 standard deviation, wait for the daily range to hit the 2 standard deviation, wait for a 1 minute break of structure, market structure shift, wait for the fair value gap to form, and then wait for the retrace into the fair value gap, and then target a 1 to 3, maybe, the mean VWAP or something else, right? It's that fucking simple. Limit order extreme, stop beyond the level, TP at VWAP, and then you can, get like a 1 to 3, a 1 to 4 on that. This is quite literally the a probabilistic 100% better way to consistently top and bottom tick and even have a fighting chance of top and bottom ticking the market. All right, so far I'm hoping that you've really enjoyed this video. It took me a long time to make, right? Like I've said for the 30th time, but I just want to kind of cut it off and really show you a final comparison for what we've kind of talked about and discussed in this whole video, and kind of the whole driving point that I want you guys to take home for yourself. Okay, let's just look at these side by side one more time, right? On one hand, you have what the internet calls, standard deviation, which is just a Fibonacci tool with a custom settings anchored around a swing leg, and it just gives you like random levels, right? That you're marking out. These levels sometimes work, they sometimes don't work. That's fine, right? If it works for you, keep using it, right? Just don't listen to me. I guess I just don't know what I'm talking about. But you know what it exactly is now. It's a fib extension, and there's no statistical understanding or means of understanding how probabilities behind that, right? But they still call it standard deviation for some reason. Okay. On the other hand, you have something real, right? Something that I just taught you, real math, a real standard deviation calculated from real data sets, from real price data, giving you an actual measurable probability that a move is exhausted, essentially. And it tells you not just, where to look, but how likely that level is to hold, right? And, one is basically just guessing with the ruler, and the other is actually, measuring with a thermometer, I'd say. Like, this is the whole analogy. You're basically measuring with a ruler or an actual thermometer. Both can be useful, but only one actually gives you a statistical edge, right? You can see right here the input data on the retail standard deviation, the fib extension, just one swing leg, while the input data is hundreds of price point, right? When you calculate it, it's just the swing times the multiplier, while we're actually using the real definition of standard deviation, it's just the square root of the variance. All right, you don't need the mean for retail, you don't need variance, right? The output is static price levels, but with standard deviation, you need the mean, the variance, and the output is dynamic probability zones, right? This doesn't give probability, it doesn't also adapt to volatility, but standard deviation absolutely does. All right, real standard deviation, it absolutely does all these things. And again, like I just said, this is just what? A Fibonacci extension? Well, this is a statistical measurement. One is just measuring with the ruler, the other is measuring with a thermometer. So I really hope you enjoyed the video. I just love bringing breakdowns, of content like this to really help you become actually profitable and understand these things on a high level. And if this, really helped you, think about the markets in a genuinely, high level defined way, if this purely just, opened your eyes, and this is the kind of stuff that you want to learn about and actually get good at in your trading, getting real results, I teach this inside my mentorship, right? Not just surface level concepts, with just fancy names, but actual math and framework behind what makes a strategy work, right? I'm not going to go into what's in my mentorship. You can go ahead and book a call with me if you're looking to join the program and become profitable, but the link is going to be in the description if you're interested. Either way, drop a comment, let me know, drop that special word that I told you guys to do in the middle of the video, and let me know if you have any other questions, right? Any other content questions, anything about day trading. I'm always going to be happy to answer that for you. And yeah, like, let me know, are you going to add VWAP bands to your strategy, and your sessions to your chart? Let me know. And with that, I just want to say I love you guys, and I will see you guys in the next video. Take care. Peace out.